Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money that makes the world go round. And today we are diving into Marriott's latest financial moves, which seem to involve a lot of borrowing to keep the hotel lights on and the rooms booked. I hope you are ready for some serious debt talk, and let me tell you, we have got some juicy numbers to unpack. Alright folks, let's get straight to the heart of this filing. Because Marriott International has been busy, they are essentially telling us that they have secured a hefty sum of money through what they call notes, meaning they are borrowing money from investors and promising to pay it back with interest. This is a pretty standard way for big companies to raise cash for all sorts of business needs. So what exactly are they doing? They've entered into something called a terms agreement, which is fancy talk for a deal to sell a bunch of debt to different groups of underwriters. Underwriters are basically the middlemen who help sell these new bonds to investors. They are selling 3 new sets of notes, which are just different versions of loans for them. These loans come with specific interest rates and payoff dates. We're talking $400 million in notes that mature in 2027 with an interest rate of 4.20%. Then there's another $500 million due in 2031 carrying a 4.45% interest rate, and finally a massive $600 million chunk due in 2030 with an interest rate of 4.255% interest rate. And finally a massive $600 million Accession with, and finally a massive $600 million N35 with a 5.250% interest rate. Add it all up and that is a staggering $1.5 billion that Marriott is borrowing. This is a significant amount of money, even for a company as large as Marriott. The total amount raised after fees and other costs comes out to about $1.477 billion. So what's the big idea behind all this borrowing? They say it's for general corporate purposes, which is a pretty broad term. It could mean anything from paying for day-to-day operations like keeping the lights on and the staff paid, to more strategic moves like buying other companies making upgrades to their hotels, perhaps even buying back their own stock to make existing shares more valuable, or just paying off other debts they might already have. Let's talk about the timing of these payments. They've got interest payment dates scattered throughout the year for these new notes. For example, the Series TT notes paying 4.20% will have interest payments twice a year, in January and July. The Series UU and VV notes both pay interest in April and October too. The earliest interest payment begins in January of next year, which is 2026. And when do they have to pay back? The big principal amounts of the Series TT notes are due in July 2027, meaning they have a little over 2 years to figure that out. The Series UU notes are due in October 2031, giving them about 7 years, and the Series VV notes have the longest runway until October 2035, so about 11 years. They also mentioned that they can redeem these notes early. This means if interest rates fall, they might buy back these higher interest notes and issue new ones at a lower rate to save money. This entire operation is happening under an older agreement called an indenture. This indenture is like the master rulebook for all their bond issuances. It was originally put in place way back in 1998 with a bank called the Bank of New York Mellon acting as the trustee. The trustee is essentially the overseer, ensuring that Marriott follows the terms of the agreement and protects the bondholders' interests. To make all this official, they've also filed updated prospectuses with the Securities and Exchange Commission. These are detailed documents that spell out all the specifics of the offering for potential investors. They are part of a larger registration statement, which is basically their public declaration that they are offering these securities. The filing also includes several attachments or exhibits, if you will. These include the actual agreement detailing the terms of the deal, the forms for each type of note, the official certificate confirming these notes are being issued according to the main indenture, and a legal opinion from their lawyers basically saying everything is on the up and up, legally speaking. These documents are important for transparency, making sure investors have all the information they need to make informed decisions about buying these Marriott bonds. The fact that they are attaching these to their public filings means they are serious about complying with all the regulatory requirements. Now, let's put this into perspective. Marriott is a huge global hospitality company known for brands like the Ritz-Carlton or Sheraton. They've navigated economic downturns and industry shifts before, but raising $1.5 billion in debt is a serious move. It signals a need for capital, perhaps, to fund growth initiatives or shore up finances in what might be an uncertain economic climate. It's like taking out a big mortgage on your business to invest in its future or pay off other bills. From a Warren Buffett perspective, You always want to see companies manage their debt responsibly. While borrowing is a normal part of business for large corporations, it's crucial to assess if the company's earnings can comfortably cover the interest payments and eventually the principal amounts. The higher the debt load, the more financial risk the company takes on. If revenues dip, those fixed interest payments can become a huge burden. For Marriott, with its diverse portfolio, the ability to generate consistent income from its hotels is key. We are talking about a significant increase in their financial obligations. The interest payments alone will be substantial each year, adding to their operating expenses. This is a strategy that bets on future growth and profitability being strong enough to handle these new debt servicing costs. It's a calculated risk to fuel their expansion or maintain their market position. So this filing isn't just about announcing that Marriott borrowed money. It's a peek into their financial strategy and their outlook on the future. They are investing for what they believe will be a profitable return. They are basically saying they are confident enough in their business to take on this debt and that they expect to generate enough cash to pay it back. Looking at Marriott's overall direction, it's clear they are a dominant player in the hospitality industry. The challenge for them now is to ensure that the investments this new debt will fund actually pay off and generate sufficient returns to comfortably manage these new financial commitments. Now, looking at these results more broadly, Marriott appears well positioned in the market with a strong brand recognized globally. However, the significant increase in their debt levels does raise a concern about their financial flexibility in the short to medium term. A strong revenue stream from their global operations is critical to service this debt. The company's strategy of raising capital through debt rather than equity can be a positive if the returns on the invested capital exceed the cost of debt, which in this case the rates are not insignificant. The maturity dates offer some breathing room, but the overall debt burden has increased substantially. My take is that Marriott is making a calculated bet on future performance, and the success of this strategy hinges entirely on their ability to maintain strong occupancy rates and revenue growth across their vast hotel network in the coming years. It's a sign of ambition, but also a clear indicator of the financial leverage they've decided to employ. Alright, that's our breakdown of Marriott's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.